investment strategist at SJS Markets. He's joining us now live from Hong Kong. Dariusz, great to see you today. Let me start off by asking you about these Japanese GDP numbers. We're expecting them to come through on Wednesday morning. What are you looking for?
We think that the Japanese data will be even worse than consensus is calling for, and our forecast is that the GDP shrank by 4.6% quarter-on-quarter, or 7.8% year-on-year. And the reason why we are more pessimistic than other investors is that it seems Asia is undergoing a process of inventory reduction that was probably responsible, for example, for the disappointing Hong Kong first quarter data, and Japan has to go through the same process. That's why it will be a horrible, horrible number. But at the same time, the silver lining is that after 2 consecutive quarters of very sharp contraction, it's very likely that starting from Q2, we will be seeing modest gains in Japanese GDP.
Modest gains from Q2 of this year?
Yes, exactly. I know it seems relatively early, but you know, it's just because of how steeply we will have fallen by Q1, and as the contraction in exports has pretty much ended, and as inventory reduction has already been largely completed, modest rebounds are very likely. Still, overall, 2009 will see a 4.5% contraction in the Japanese economy, but things can only get better from now.
You mentioned Hong Kong, that weaker than expected GDP numbers that we had out on Friday. Now, we've also heard that a new stimulus package is likely to be in the works. Just what are you expecting to see from that region?
I think that in most of East Asian economies, aside from China, we have to see a very negative GDP data for the entire year. But as was the case for Japan and Hong Kong, most likely for other East Asian economies, we are going to see that the first quarter was the worst. And because of how bad it was, those economies will modestly improve already starting in Q2 on the back of rising demand from China, which is picking up steam, and also on the back of the fact that the US economy will start expanding in Q3, and this will generate demand for export out of Asia.
Now, you believe that this kind of correction that we're seeing will continue, but this does open up a number of buying opportunities on the market. So how do you strategize in terms of, you know, how do you balance these very significant risks that still remain to these quite, I guess, relatively optimistic forecasts that you're talking through?
In the short term, I think that the correction that we saw last week, or pretty much since the release of US bank stress test results, needs to continue because of how fast and how far markets moved up between the beginning of March and the beginning of May. Too much good news had been priced in, and now those who made profits over that period of time are taking money off the table and booking those gains. But there is no way in my mind for equity markets to go back to the lows of early March, because we now have much more confidence in macroeconomic outlook, as opposed to the beginning of the year when the global economy was in a free fall. Therefore, the correction we are undergoing right now is a great buying opportunity. By the end of the year, all risky assets, equities, commodities, emerging market assets, corporate credits, will be much higher than they are right now. So this is a time when we can have another chance to jump into the market.
Dariusz, let me ask you just very briefly before we go about the Bank of Thailand. There's a central bank meeting this week. How are you positioning ahead of that?
We are in line with consensus here that they will cut the target rate by another 25 basis points to 1 percentage point. This is pretty much priced in, so it shouldn't really impact either equities or the currency. So both of them will actually have to drift lower in line with global trends, I think, for at least 1 more week.
All right. Dariusz, great to have you with us today. Thank you for joining us on Cash Flow. Dariusz Kowalczyk with me from SJS Markets. Coming up next, our next